Welcome to the September 8th, 2025 Advanced Report for McGowanGroup clients and NetWorthRadio.com listeners. We're going to start with three basic questions, and I'm going to take you to some investing concepts that I'm not hearing anywhere else, and it could be one of the most important portfolio strategy briefings that you've ever had. Let's start. 2026 important trends for investors. Why did I say 2026? Because people are thinking in terms of 3 weeks, 3 months, 3 minutes sometimes on the financial headlines. Therefore, we get to question one. With headlines focused on short-term anxiety, what are the most important themes for long-term investors to remember the next 18 months, the next 3 years, the next 5 years, the next 10 years? We're going to talk about some target returns in that zone and some strategy that can give you dry gunpowder during the times that you wish you had it. Just like we covered April, during that decline, we were adding great dividend companies in the value sector. So we'll deal with sectors. What is an overpriced slowing growth spanking? Get that term. I came up with it this week. Overpriced, slowing growth, spanking. I'm going to show you a great example of that, and you'll remember the events that were going on at the time. And then how could investors avoid one of those? Well, the first is don't buy things that are overpriced. It's easier in hindsight to decide that. Which sectors of the financial markets are considered boring choices but are currently attractive based upon estimated forward reliable returns, which starts with how much do we get paid for owning it, right? That way you got a few dollars left over after paying expenses. Great way to build a portfolio. And you have a baseline for your forward return. Now, here we go. I'm going to cover the categories that do that. Growth with income. Those are dividend companies. High cash flow, that's global lending. If you thought of yourself as a bank, you got a big pile of loans and bonds, you get interest every day. Some people won't pay, you adjust for that, and that's why the banks have the big buildings and make lots of money. Wow. So why don't you cut out the middleman and be the bank? We have 5 great managers in the portfolios that are really good at bonds, and I'm going to cover you some of the insights that come from owning a big pile of loans and bonds and getting paid every day, and how that works during crisis. Safety and income, tactical safety. I don't hear many people talking about having a safety reserve in the portfolio, and the yields are coming down, and I'm about to cover that too. Right? With the Federal Reserve. What happened this week? Growth with innovation. This is where everybody's focused. If everybody's looking in the same spot, maybe we take a step back and say, wait a second. If everybody's talking about this, there might be something wrong with it. It could be overpriced. And I'll give you an example as we go. Now, this week, this is a huge event, all right? Look at this. Boom. Federal Reserve has been stubborn. I don't think Jerome Powell likes Trump, and Trump clearly doesn't like him because it calls him a loser and a fool and worse. Anyway, so Trump's insults to Jerome Powell, the rates ought to be lower. Where should the rates be? Well, if you study the Federal Reserve, here's a key insight. Inflation is below 3 by any measure. Now, they stayed at 4 1/3% on the T-bill, just recently 4.4, because they set the Fed funds target. That's the cash rate. And the T-bill follows that rate. When the T-bill moves ahead of the Fed funds current target, there's a reason. Well, the first reason, think longer term, not just September 30th, will the Fed cut rates? That's going to be a big debate in the financial media. That's why you subscribe here, because we're also thinking, how do I make the best return over the next 18 months? What's going to happen, and what would endanger my returns? All right, I'll show you that in a second. The T-bill rate goes to 4%. The Fed target's up here. What is that telling us? That tells us trillions of dollars already know the Fed is going to cut. But there's something else that's important about this cut, and it may send a little panic through the markets. 4%. Here's 4 1/3. That's the midpoint of 4.5 to 4 1/4, which is current Fed target. They set the overnight bank lending rate, T-bills follow. When T-bills move ahead, they already went to 4. Well, if the Fed cut the rates by 1/4, you'd be at 4.125. Why are you at 4? Why would an institution put billions of dollars below the Fed's target and below where they would be if they cut rates by 1/4? Because inflation is under 3, that means they're going to cut rates likely 5 times over the next 18 months, and that's what the Fed funds forecast says. What does that mean? Net present value of future cash flow skyrockets when the comparison rate is lower, right? Net present value of future cash flows divided by your discount rate. In this case, we're using the Fed funds rate. Wow, that is a big difference. Think in terms of 18 months instead of 18 days, right, till the Fed cuts rates. Well, they're finally starting that. Jerome Powell stayed at 0 way too long, and he stayed way up here way too long. And the only reason in the past that they've cut rates quickly is a big recession. We've never seen an environment, really since the 80s, where the Fed is just gradually cutting rates. That's good for mortgages. It should be good for the housing market. It's stalled right now. But that says the markets reacted, and they're already building that in. This week, the equity indexes danced near record highs. And the NASDAQ is the big story. Wow, this is reflective of the fact that you have about 10 companies that make up over 30% of the whole market. Everybody's focused there. Palantir, NVIDIA. And are those the right answer? I don't know. But I will tell you this. Look at this. This is the value of all stocks, right, divided by GDP. For the first time in history, it is 2.6 times GDP. The value of all stocks is 65 trillion. The economy is 23.6 trillion. Wow. It's never happened. We go all the way back to 1996. Wow. And it hasn't happened that it's that ratio. So, overpriced, slowing growth, spanking. I'm going to take you through a quick story. Zoom. You know, Zoom, right? We've all done Zoom meetings, and that was the only way we could get together in the pandemic because we're locked in our houses, and a lot of people would wear their mask in the Zoom meeting, right? So everybody had to get good at Zoom. So you could have online meeting, you could see your kids, your grandkids, whatever. And then you're locked in your house, so you probably buy a Peloton bike too. That was a wise decision. But anyway, look right here. So Zoom going into the pandemic, right down here at 50 bucks. And it goes to 588. Why? Because it exploded. Now everybody had to have Zoom. Boom. Did they overprice it? Well, in retrospect, this might have been a little too expensive. It might have been overpriced. But then everybody had Zoom that was going to get Zoom, and it zoomed from 588 to 55. A 90% loss. That's what happens if you overpay, right, for slowing growth. What a great lesson. Don't do that. Because if you're paying 50 or 100 times earnings and the growth rate slows, you're going to get a spanking. And we don't want spankings. Let's talk about something boring, right? I said I'm going to cover some of the boring choices that could be in a portfolio. Well, I go all the way back to 2003. This is just a basket of B-rated corporate bonds. Now, remember, investment grade is A team, the B team is average company, and C team is distressed company, right? You ask, the average credit rating, you ask a room full of 100 people, how many are above average? About 70 of them will raise their hand, but that's a different story. Anyway, B is average. So this is a B-rated basket of bonds. And we go back 12 years. We include the pandemic. We include 2008. Well, we got all that interest and we just reinvested it and boom, we end up with 8%. That's pretty good, right? 12 years, 8%. We're like, no, I'm going to double over in Palantir. Well, maybe you will. I don't know. But what if the growth rate slows? They're going to finish all these data centers and the build out's going to be over. That looks like 1999. They're not done yet, but some of these things are already overpriced. So when you build a portfolio, you want to get good at more boring areas. I'll show you one other boring area. Wow. Here, I'm 6.8% average. I go from 2020 through the pandemic and rates are going up. This is a basket of mortgage bonds. Yeah, it's boring, but it pays 5%. Rates are likely to go to 3% by the end of 2026. There's an embedded capital gain in here, and I got an average return that's just under 7% from inception. I'm getting 5% in cash. So what does that tell us? That tells us that if we look at our forward returns, and I pay 50 times earnings for a company, sometimes that's worth it. But that's only 2%. If the company doubles, then my earnings yield is 4%. Well, what if I just started at 5 or 8% in current yield in cash? And from the peaks of the markets, that's one of the techniques that can help you. Let me tell you something else about the prior slide. If we can go back one, that says, whoa, look at this. You could buy double-digit cash returns in bonds that were way below par, and they recovered faster than stocks. That's how we recovered from '08 in about 9 months. And we did it with record income. We were getting paid the whole time. That's a technique that helps you through crisis because you have to pay your bonds before the shareholders get anything. And that may be one of the best opportunities coming at the next crisis. That's why you want to be with McGowanGroup Wealth Management. I'm Spencer McGowan, President, McGowanGroup Wealth Management, your financial weatherman. Thank you for subscribing, and be sure to forward it to your executor or trustee or the kid that's going to have to take care of you when we all start to forget. Get them educated too. Thank you for tuning in today to Net Worth Media. We also have Apple Podcast. Simply type in Net Worth Radio and boom, it'll hit your phone right then. If you also go to networthradio.com on a browser, you're going to be able to meet the team. You could see our performance track record, the model portfolios that go with today's broadcast. Also at networthradio.com, the longer play podcast is available there as well. We're grateful that you've tuned in. Remember, when we talk about a security, it doesn't make it a recommendation for your portfolio until we actually complete a written plan for you by Zoom or in office or simply a conference call. So you reach us at networthradio.com if you want to get that arranged. Market fluctuations and how to handle them. We build high cash flow portfolios, and past performance doesn't guarantee future results, so you do have to be ready for challenging markets. We can build more cash flow during challenging markets than we can when everybody's happy and everything's up, which is when we tend to raise tactical safety. Those allocation strategies are here at networthradio.com. Thank you for tuning in.